All right, let's talk taxes. In this explainer, we're going to demystify the two most important parts of your federal income tax, the standard deduction and tax brackets. By the end, you'll see exactly how they work together. And trust me, it's probably not what you think.
So let's just dive right into the biggest fear people have. We've all heard it, right? Someone's afraid to take a raise because they think moving into a higher tax bracket will somehow make them lose money. But is that even possible? Let's find out.
To answer that question, we have to start at the very beginning with something I like to call your built-in tax shield. Before a single dollar of your income even gets looked at by the tax brackets, you get a massive head start. And this is called the standard deduction. Think of it like this. The government basically gives you a free pass on a big chunk of your income right off the top. You don't have to do anything special to get it, and it immediately lowers the amount of money that can even be considered for tax in the first place. Okay, so let's look at the actual numbers for the 2026 tax year. Go ahead and find your filing status on this chart, whether you're single, married filing jointly, or a head of household. This number right here is your starting point for a lower tax bill. So to make this totally real, if you're a single filer, the first $16,100 you earn in 2026 is completely shielded from federal income tax. It's not taxed at 10%, it's not taxed at 1%, it's taxed at zero, zilch. So the obvious question is, what happens to the money you earn above that tax-free amount? Well, this is where tax brackets come in, and honestly, where most of the confusion starts. It really helps to think of it less like jumping off a cliff and way more like climbing a ladder. Okay, listen up, because if you only remember one thing from this whole explainer, make it this. You do not pay your highest tax rate on all of your income. It's not how it works at all. And this slide just lays it out perfectly. The common fear, over there on the left, is that all your money gets dumped into one big bucket and gets hammered with a single high tax rate. But the reality, on the right, is so much better. Your income fills up a series of smaller buckets, one after the other, and each bucket is taxed at its own progressively higher rate. Just take a look at the first few brackets here for single filers in 2026. Your first dollars of taxable income, and remember, that's your income after the standard deduction, they're taxed at just 10%. Then only the dollars you earn above that first level get taxed at 12%, and so on. You're just climbing from one rung to the next. Now, theory is one thing, but let's see it in action. We're going to put the standard deduction and the tax brackets together with a really simple example. And this is where it all clicks. Okay, let's imagine a single filer who earns $60,000 a year. First thing we do, we just subtract their standard deduction of $16,100. Instantly, poof, the amount of income that the IRS can even tax drops all the way down to $43,900. Now we apply the buckets. Of that taxable income, the first $12,400 is taxed at that low 10% rate. The rest of their income then falls into the 12% bucket. And notice what's missing? Those higher tax rates, like 22 or 24%, they don't even come into play for this person. Not at all. Okay, now that we've seen the mechanics, let's use our new knowledge to officially and permanently bust some of the most common and costly myths about taxes. And here it is, the big one we started with. The idea that getting a raise that bumps you into a new bracket is a bad thing. We now know this is completely 100% false. So here's the key takeaway. Earning more money will always mean you have more money in your pocket after taxes. Only the few extra dollars that actually tip you into a new bracket are taxed at that higher rate. Everything you earned before is untouched. A raise is always a good thing.
Here's another one I hear all the time. People assume that because the standard deduction is so simple, it must just be for people who don't earn a lot of money or, don't have complicated finances.
But that's not true at all. The reality is you get a choice. You can either check the standard deduction or you can itemize, which just means adding up specific expenses like mortgage interest. You simply pick whichever option is bigger and saves you more money. It has absolutely nothing to do with your income level. All right, let's put this all into practice. Here's a quick plan you can use right now to get a solid estimate of your own tax situation for 2026. It's really that simple. First, find your filing status and its standard deduction. Second, subtract that from your estimated income to find your taxable income. And third, look at the tax bracket table to see where you land. This gives you a powerful snapshot and helps you plan ahead.
So we've kind of demystified the system. You now know that a large portion of your income is tax-free, and that tax brackets are just a ladder you climb, not a cliff you fall off. And understanding these rules is the first and most important step to taking control of your financial